Hi everyone, today I'll be recommending 3 more dividend growth stocks for your portfolio. Please check out the previous non-dividend ETF video I made a few weeks ago, then check out the higher yield dividend video I made last week. This week is lower yield but higher stock growth. These are Canadian companies that have beaten the TSX over the last 5 years, but also offer a dividend. Please keep in mind, a distribution is different than a dividend. A dividend is a share of a company's profit, whereas a distribution could be return of capital or income from a covered call ETF or from a trust. I've been getting a lot of questions on why I'm not recommending those high yield covered call items, but this is a company dividend video. Please a thumbs up for the quick intro and subscribe to the channel where I give stock recommendations, tax advice, Canadian finance advice, and once a month, I'll do a live trading of a stock option strategy. The first stock offers a sustainable dividend backed by a vast transportation network. The second stock offers a high yield backed by a diversified financial portfolio. And the last stock is offering a dividend with a strong global growth strategy. First recommendation is CNR, Canadian National Railway. Currently trading at $156 per share. They're slightly down from earlier in the year when they were trading in the $180 range. So just based on the long-term outlook, this appears to be one of those dips where you can load up on the stock in anticipation of future growth, obviously. They've increased 30% over the last 5 years. So not taking into account the dividends, that's only the stock price appreciation, which is under the TSX average. But what you can count on is the dividend payout and increasing dividends. Currently paying a 2.16% yield. It doesn't seem like much, but that's because the stock has been appreciating. This is a long-term hold. A $10,000 investment would only yield $216 per year or $54 per payment. However, they've been increasing dividends over the last 4 years. Look at the recent dividend history. Quarterly dividends, 4 years ago, it was 60 cents per quarter, and then 68 cents a year later, which is a 13% increase. But if you look at the increase from 4 years ago, 25 cents per quarter up from 60 to 85 is a 41% increase. Now imagine you've been reinvesting these into a dividend reinvestment plan. You would need a huge investment to be able to get one share. So you would need around $29,000 invested to be able to drip the shares. One item to keep in mind, if Canada does get hit with those 25% tariffs, the cross-border trade and trade in general might go down. So this stock will take a short-term hit, but don't panic. I'm confident in this over the long term. Second recommendation, making another appearance on the channel, is CIBC. I recommended TD last week, but it had a higher yield and maybe higher room to grow in terms of stock price because of the recent penalties they've been hit. However, the last 5 years have been very favorable for CIBC, making 57% stock appreciation, which is higher than the TSX returns, but that's not including dividends. So the total return, if we include dividends, is probably 50% higher than the TSX. They've been paying a quarterly dividend with an annual yield of 3.96%. So a $10,000 investment would get you $396 per year or $99 per payment or per quarter. If you want to reinvest the dividends into a dividend reinvestment plan or a DRIP, you would need around $9,500 invested to be able to get one dividend per payment to earn one share per payment. They've never missed a dividend payment, but their dividend increase rate isn't as consistent. They've been increasing for 4 years. They took a slight decrease during the March 2020 pandemic, but quickly recovered. Looking at the dividend from 4 years ago, they were paying 76 cents per share, increasing to 90 cents per share, an 18% increase over 4 years. But if we want to look at the last 27 years, that's the data I have, the average increase is 7.6% for dividend payments. If you invested over the last 27 years, you would have had a 7.6 pay raise in dividends every year, not taking into account the stock price. Compared to US banks, Canadian banks are far more conservative. There's only like 6 or 7 big banks for 40 million Canadians. So the oligopoly is backed or saved by the Canadian government, making this a safe investment in good times and bad. Last recommendation, also making its second appearance on the channel. I recommended this a few years ago when it was much cheaper. This one was a surprise to me, to be honest, is ATD. I'm not going to butcher the name again, so I'll just call it Couche-Tard. They're currently trading at $82 per share. They've increased 87% over the last 5 years, so almost doubling the returns of the TSX. Although they've been increasing their dividend payments, the raises haven't been keeping up with the stock price, so the yield seems super low. It's only 0.85%, which is pretty bad if you want to live off of it. However, I recommend this as a long-term hold, not something you can live off of for now. A $10,000 investment only yields $85 a year. I know it sounds bad, but bear with me. They've been increasing their dividends for 16 years. The payout ratio is only 18% of earnings, so they have so much room to increase the dividends as well as reinvest into the company without having cash flow issues or income issues. If we look at the dividend from 4 years ago, they used to pay 7 cents per quarter, and now it's 19 cents per quarter, which is a 170% increase. And I can only see it going up from here. I'm going to make a prediction. I think it's going to double again 4 years from now. It's hard to recommend the drip for this one. You need so much invested to be able to enroll. You need around $40,000, which is a lot to ask, especially since these are beginner videos and I don't expect anyone to put all of their investment into one stock. For all of these recommendations, please invest in your FHSA, RSP, or TFSA first. Make sure to max those out. Those are your tax sheltered accounts. If you want to buy a house in the near future, an FHSA is the best option. If you make over $100,000, I'll say RSP is the best due to the tax refund. If you make less, I think TFSA is the best. But again, everyone's situation is different, so I'm just giving my personal opinion on that. I try to keep these short. People tend to turn it off after 7 minutes. So we'll see how long this one is. These dividend and stock recommendation videos seem to be very popular. The issue is I've already recommended everything like 2 years ago. I've recommended all the good stocks in the TSX and I'm repeating myself. So hopefully it doesn't annoy the past subscribers. But thanks for watching. Let me know if you have any questions and any recommendations and tune into the next one.